Hi, I'm Eric Clark, and I'm a portfolio manager from AccuVest Global Advisors and the co-creator of an innovative and important new index called the Alpha Brands Consumer Spending Index. On Bloomberg, you can find the index under the symbol BRANDS. This is the first of a series of short videos discussing three things: portfolio construction, creating the right core index, and then the drivers of the real economy. This video I'll concentrate on why we created the index and why we think it's important and the market needs a more appropriate core index. So let's run through a few important slides. First, I want to set the stage. Large cap investing tends to be the largest part of somebody's portfolio, and arguably it's a proxy for investing in the U.S. economy. So I think it's important to understand the components of the U.S. economy. So on this first slide, we have GDP equals consumption plus investment plus government spending, and then you net out exports, and that is your total GDP. If you take a look at the next slide, we have about a $17 trillion economy. 12.2 trillion, or roughly 70% of that, comes from consumption. So the consumption component of the GDP number is a highly important number to track. We have a 50-year view of GDP. And as you can see, there are a few lines that are either trending down or highly volatile, but one line that is not trending down nor has been volatile is the green line of consumption. The consumption line of GDP has been steady and has been rising over the last 50 years, making it increasingly more important to track from a U.S. large cap perspective. Roughly $2.2 trillion is currently benchmarked against the S&P 500, which makes it a pretty important benchmark. Our issue with the index is that it doesn't track the real economy, and that's why we created the Consumer Spending Index. If the S&P is investing in the leading companies as a proxy for the U.S. economy, why does it only contain 22% consumer stocks? From our perspective, if you're investing in large cap stocks as a proxy to track the economy, then your core allocation should have more consumer stocks as a part of the allocation. As you can see, since 1989, this chart shows that consumer discretionary and consumer staple stocks have outperformed the S&P 500 pretty dramatically. We would expect that given how important the consumption component of the GDP is. So we've proven that since 1989, when the indexes were formed, consumer stocks in aggregate have outperformed the S&P 500. An astute question would be what happens when the economy isn't performing particularly well, or when the economy is going through a recession. Interestingly, the next couple of slides look at consumer stocks during different bear markets and corrections. The first chart is the bear market from 2000 through 2002. Defensive stocks offered a positive return, and discretionary stocks outperformed the S&P 500 slightly, although were negative. In the second bear market, from peak 2007 till the bottom in 2009, defensive staples were negative but performed much better than the S&P 500, and discretionary stocks again performed in line with the S&P 500. Lastly, in the 2011 correction, the S&P at its worst was down 21%. The consumer staples, because of their defensive characteristics, were much less negative, and the discretionary stocks performed in line with the S&P 500. All in all, during expansions, we should expect consumer discretionary stocks to outperform the S&P 500 as they have over the last 30 years. And then during difficult times, consumer staples, because of their predictable earning streams, have tended to either be positive or much less negative than the S&P. Our $18 trillion U.S. economy is driven by consumption. 70% of it comes from the consumer. So a more appropriate core index should be one that overweights consumer discretionary and consumer staple stocks. And using history as a guide, that overweight could be all you need for a better chance at outperforming the S&P 500.